A very good morning, students. Our session of corporate finance. Now, as far as our previous session was concerned, in that we already discussed about the factors involved in measuring the profitability and capital rationing. So, today we are going to discuss the few techniques, different techniques through which the organization is able to make the decision whether to select the particular project or not. So here are 5 different techniques through which the management is able to make their decision about the capital budgeting. So now let's discuss these techniques one by one. The first one is payback period method. The name itself suggests that in how many times you are getting your capital back. That is payback period method. Suppose my investment in particular project is 2 lakh rupees. So now with the help of this payback period method, in how many years I am going to get my investment back. That is, in how many years I am getting my 2 lakh back. That is the technique of payback period method. Now first let's discuss the introduction part. Payback period method is defined as the length of time required for the stream of cash proceeds produced by an investment to equal the original cash outlay required by the investment. So simply, in how many periods you are getting your capital back. That is the simplest method of capital budgeting. This is one of the most popular and simplest method of evaluating investment proposal. It takes into account the time period required to recover the original cash outlay invested in the project. Payback period method ma we are least concerned with the return part. Means what our investment is earning. We are least concerned with that part. But first and foremostly, we are going to make the analysis that in how many period of time we are getting our original capital back. So there are few advantages of this method. Let's discuss first the advantages. It is simple to understand and easy to calculate. It gives an idea of the speed with which the original investment is recovered. It gives protection against risk of obsolescence in the modern age where technological change are taking place rapidly, because it favors project with shortest payback period. The profitability of a project does not depends on total return only, but on when it is available and how speedily it is available. Then after, a firm which is troubled by shortage of cash can use this method in a proper manner by accepting that project which has shortest payback period. The cost and sales price can be easily estimated if the payback period is short. It is useful guide to investment policy. It lays stress on liquidity. It gives protection against risk. So basically there are many advantages of this payback period method. Again, there are few limitations of it. Let's discuss the limitations. First, it fails to take into account the time factor. It gives equal weightage to cash flow received at different point of time. So here the time value of money, the concept of time value of money is totally ignored in this method. The second one is this method does not give a correct idea of the profitability of the project. Yes, through this method we are not able to get the idea that what is the profitability of the particular project. Then after, the method prefers only those projects which have short payback period, but they are least concerned about the profitability part of that particular project. Means they are not going to consider that if the project has a long payback period but the profitability ratio is maximum in that particular project. So again there are few limitations of payback period method. But if the organization is dealing in very sensitive project, the capital involvement in that particular project is really very high. At that time they are not going to adopt this method, that is the payback period method, because it is the simplest method and the method does not conclude the profitability part of the particular project. Then after, the second method, that is accounting rate of return method. Now in this method, average income is divided by average investment. Here whatever earning of the organization is, that is divided by the investment, and that is the average investment of the particular project. Average income is obtained from the profit shown in the profit and loss account. Rate of return is assessed on the basis of accounting profit and not cash. So here maximum focus is given to the annual profit of the particular project along with the amount of investment in that particular project. Rate of return is assessed on the basis of accounting profit and not cash now. The depreciation charges and taxes are deducted from profit, which then is divided by the number of years to get average income per year. So again, the average of investment, the average of income, that is going to be analyzed in this particular formula. The formula of accounting rate of return is average annual profit after tax, that is divided by average investment. And the formula of average investment is total value of investment plus scrap value, that is divided by 2. So again, this is the simplest method for the capital budgeting. Now let's discuss its advantages and limitations part. It is easy to understand and convenience to use. So it is again a simple method, so easy to understand and easy to apply. The figure of income are to be obtained from profit and loss account. No further calculations are required. The entire income of the project is taken into account under this method. It points to different alternative avenues of investment. It takes into considerations the saving over the whole working life of the project. There are few limitations of it. Now let's discuss it. A serious limitations of this method is it does not take note of cash flow. So here the return is going to be ignored. Cash flow is not going to be calculated in this method. So organization is not able to know that what is the actual income of this particular project. Then after, the project yield different amount of income at different point of time. It is not like that the project is earning the same amount every year, but they are earning different amount in the different year. So that point is totally ignored in this method. So this is one of the biggest limitations of the method. Here every factors are not going to be considered. It does not suggest whether a project should be accepted unless it is compared with the particular rate of return. So, like other methods, there are few advantages and few limitations of it. Then after, the next method is net present value method. Now this is already discussed in our semester 3 net present value method. I hope that part is clear to everyone. So I'm not going to discuss this one because already we get the idea of this method. Now take a time of 2 minutes and just read it out. The next method is profitability index method. The name itself suggests that the method is based upon the present value of cash flow of the particular project. Now in this method gives a proportion of present value of cash inflow and the present value of cash outflow. So on the basis of cost and on the basis of revenue, the whole investment is going to be considered. It is the ratio of future cash benefits to initial cash flow. So again, in this method, the cash inflow, that is the revenue of the particular project, is going to be analyzed and it is going to be compared with the cash outflow. Now cash outflow is nothing but the cost of the particular project. Now if the index rate is greater than 1, then the organization is going to accept the project. And if the index rate is 0 or if it is negative, then it is going to be rejected. So again, it is the simple method for the calculation of or for the selecting any capital project. The formula of profitability index is present value of cash inflow, that is divided by present value of the investment. Now normally this is the ideal method for the evaluating an investment project. This method gives due importance to the time factors. So this is the best method for the selecting any capital project. And then after, the last method is internal rate of return method. In this method, the rate of interest or discount is to be found out. The procedure is to find a rate of interest that will make the present value of cash proceeds accepted from an investment equals to the present value of cash outlay required by the investment. This is somehow complex method for calculating the profitability of the particular project. The basic process is the selection of some rates, and that is totally depends upon the present value of cash inflow during the life of the project is going to be considered. Now suppose if the present value is higher than the amount of investment or the amount of cash outlay, so that is going to be considered with the another higher rate of interest. So ultimately the present value is going to be focused, and on the basis of that present value the internal rate of return is going to be calculated. Here two different rates are going to be compared with each other. The rate of lower trail, then after the rate of upper trail, that is going to be considered. Now the formula of IRR, that is A plus C upon C plus D, that is multiplied by B minus A. So through this formula we are getting the internal rate of return.